there may be many different reasons why people struggle with how to save money. One of the more common reasons is that some of us simply don't know where to begin when it comes to saving money. Should we be saving for an emergency fund first, or should we be saving for a vacation, maybe a retirement, or maybe we should be focusing on paying off debt first before starting to save altogether? All those are good questions and can be confusing. So today I'll try to bring some clarity to things we should be saving for in the order of priority. And yes, that means I'll be talking about what we should be saving for first, second, third, etc., and why this order matters. Now, the way I see it, there are two main areas for savings. The first one being larger things that apply to everyone just about all of the time. I call those things main savings, and these usually include things like emergency funds and retirement. And then there's the second area of smaller things, or maybe things that pop up periodically that don't apply to us all of the time. This usually includes things like vacations and large purchases. So for the purpose of today's video, I will be talking about main savings first, then secondary savings, and then at the very end, we'll talk about how to bring the two together. So let's begin. Okay, main savings. The first one there is emergency fund of $1,000. I can't even tell you how many times I've heard people say that they were saving for something and then something else happened and they had to take their savings and use it to pay the expenses. For example, if you were saving for a vacation and you set aside $100 there, and then $200, and then $300, by that point in your head, you already see yourself enjoying this vacation. The sun, the food, the entertainment, everything that you've been imagining, you're already enjoying this. Well, if at that point something happens, like maybe your car breaks down and you have to take this money and pay for car repairs instead, then it can really feel like you were robbed, that you were robbed of that experience that you were so looking forward to over here. And being robbed of their experience can feel heartbreaking, and it can really kill your motivation to continue saving in the future. Which is why we say that emergency fund savings of $1,000 should come first. This way, when you have your emergency fund in place and then you are saving for a vacation afterwards, should your car break down at that point, you already have the money to pay for it. You are prepared, and it doesn't sacrifice that experience that you were so looking forward to doing in terms of vacation. And yes, for those of you wondering, you'll have to replenish your emergency fund at some point, but it feels empowering being prepared for the unexpected. And feeling empowered in turn helps us feel even more motivated to continue saving in the future. So, emergency fund savings of $1,000 always comes first. Number two is start contributing into employer-sponsored 401k or an IRA account. Now, a lot can be said here, but since this is not a retirement account video and we are covering quite a few things today, I will be pretty brief here. In a nutshell, if you work for a decent-sized company, chances are you have access to what they call a 401k retirement savings plan. And if you put some money into this plan, then chances are your employer put some money into this plan also. Now, this is something you'd want to check with your employer about because it can vary from one company to the next, but in most cases, when you put in $1, your company will also put in $1. When you put in $5, they also put in $5, up to a certain limit. And again, in most cases, to reach that limit, you'd want to put away 6% of your pay into this plan in order to take advantage of all this money that your employer is giving out on your behalf. So 6% of your pay translates to about $60 for every $1,000 that you make. So if you make $1,000 a month, put $60 into your 401k. If you make $2,000 a month, put $120 into your 401k, and then etc. This money will get automatically deducted from your paycheck before it hits your bank account. So this one you'll just have to believe me on, but you will very quickly get used to not having this money available to you every week. Now, if you have room to put aside a little bit more than 6%, then shoot for 10% if you're a male, and then 12% if you're a female. Sorry ladies, but women still make a little less money than men, and we still take a little bit more time away from work to care for children and sick relatives. So to make up for that difference, we have to save a little bit more into our 401ks. Now, if for whatever reason you don't have access to a 401k, then you may consider contributing into an IRA account. Those you can usually set up with most banks and financial institutions, and there are dedicated companies like Fidelity that you can set up an account with too. Just shoot for the same percentages to get started, either 6% or all the way up to 12%, depending on your situation. Number 3 is paying off debt except for the mortgage. Paying down debt can have a huge effect on our quality of life. And I know everybody's situation is a little bit different, but most of us also know how much we spend every single month on various payments. So payments to credit cards, student loans, car loans, and even mortgage. Think of your total. And then imagine that one day your debt just poof and disappeared. And all of a sudden, this amount of money that you were just thinking about is yours to keep and use however you like. What would you use it for? Travel? Entertainment? Home improvement? Something else? Think about it. It's huge. And when you're ready to tackle number 3, just pick a good debt repayment strategies and start chipping off of that debt. I do have a really good video that I will link down below for you to check out about 3 most common debt repayment strategies. So take a look at that too. Now these next 4 are pretty similar, and they have everything to do with increasing your emergency fund. First to 3 months worth of living expenses, then 6 months, 9 months, and eventually 12 months. The part I'd like to focus on here is the living expenses part. What is it? Is it your total income, before taxes, after taxes? Is it the money that you actually live on? Does it include your bills? Does it include your debt payments? So what does it include exactly? And the simplest way to explain this is through an example. Say you and your spouse both work and you bring home $4,500 every single month. Now, out of this $4,500, you use $4,000 to live on, pay your bills, and pay for your debt, while the remaining $500 you use to save for things like an emergency fund. Well, in this example, you'd want to focus on that first $4,000 that you live on, pay your bills, and pay for your debts. That's your living expenses. And to figure out 3 month worth, you take 4,000 times 3 months equals 12 months total. Now, this $12,000 emergency fund is not in addition to the $1,000 that you already have from before. This is $12,000 total that you want to have saved up. So basically, you already have $1,000. To get to $12,000, you need an additional $11,000. The same thing happens when you move on to 6 months worth of expenses. It's not 6 months plus 3 months, it's 6 months total. So you already have $12,000. You're just adding on top of it to get to 24. The same applies to 9 months and eventually 12 months. So the common question I get here is, why do we have to have 4 different goals instead of 1? It seems like it would be much easier to just have 1. And the reason there is that it can be pretty overwhelming and daunting to have to look at that 12 months number all at the same time when you're just starting out at 1,000, and it may feel like it's undoable. By breaking it down into smaller chunks, we tell our brain that yes, in fact, I can reach this large goal at the end if I only do small things one at a time to work up to it. Plus, by having smaller goals, it gives us a chance to work in some of those secondary goals in between if we need to. Number 8 is to max out your 401k and IRA contributions. We already touched on retirement accounts in number 2, but we talked about the minimums at that point. Minimums being anywhere between 6 and 12% depending on your situation. Now we're starting to talk about the maximums, and the maximum retirement account contribution is set every year by the IRS. In 2020, the max contribution for 401k by any individual is set at $19,500 per year, which works out to approximately $1,625 per month. Now, this is a large amount, and full disclosure, most people are unable to contribute this much into their retirement accounts. So if that's you, don't feel bad, just do the best you can. Every single dollar that you can contribute into your retirement above those minimums will make a big difference by the time you cash it in at retirement. So do your very best. Now, just like we did in number 2, let's touch briefly on the IRAs here too. Now, the IRS also sets a limit for IRA contributions every year, and in 2020, those limits are $6,000 for people under 50, and then $7,000 for people over 50. As you can see, IRA limits are quite a bit lower than 401k limits, so they're much easier to reach. If you can't, however, again, don't feel bad, just do the best you can. If, however, you find yourself in a situation where you can contribute the full IRA limit in a year and then still have some money left over, that's at the time to open a brokerage account and start stashing the extra cash there. And if you can, shoot for the same limits, $19,500 as the 401k accounts have. Now, if you were able to get through all 8 of these savings goals, then congratulations. You're in a really good financial spot and you're way ahead most people in this country, and that's awesome. If on an odd chance you still have some money left over, and that means that most of your debts are paid off except for your mortgage and that you're maxing out your retirement funds, then and only then you can consider one of these 2 bonus goals. First one being is paying down your mortgage faster, and this one is pretty straightforward. Basically, you'll take your extra funds and you'll just throw them at your mortgage loan to pay down that balance as fast as possible. And then second being is starting a college fund for your kids. And this one is not so straightforward. It can be a little tricky because we all love our children and we all want what's best for them. And it is very easy to start feeling that it is our parental responsibility to pay for their college expenses and to protect them from student loans. Well, before you start saving for college, consider this. Chances are, if you move through the 8 main goals, by the time your kids are in college, you will be in a pretty good financial spot and you will be able to help them out financially anyways. And if not, then that's when your kids can apply for things like scholarships and student loans. And yes, I know student loans are scary and we want to protect our kids from them. But think about it this way. At least they will be able to borrow for the college if they need to, because you will never, ever, ever be able to borrow for your retirement if you need to. So think about that. They can borrow for school, you cannot borrow for retirement. What should come first? Last but not least, we need to talk about those secondary savings goals. But before we jump into those, please consider subscribing to this channel where I make videos on budgeting family finances without sacrificing the fun and fulfilling family life. Also, please consider giving this video a like to help support me and encourage me to make even more videos like this one. But back to those secondary goals. Basically, secondary savings goals are those things that come up for most of us periodically. And these generally include things like saving for a large purchase. I'm reading here so I don't forget anything, so stay with me. So they include saving for a large purchase, saving for a Christmas fund, saving for a vacation, saving for a home improvement project, saving for a new car down payment, and saving for a home purchase down payment. Now, as you can see, most of these things come up for us at least at some point in our lives. But they can look and feel very different from one person to the next. So let's use home purchase down payment as an example. Some people choose to buy a home in their 20s, and chances are in their 20s they're still single and they're just starting out in their career, so the income is limited. But the time is not. Generally, people in their 20s have all the time in the world to pay off these loans. Now, as opposed to someone in their 20s, some people choose to buy their homes in their 50s, and that will look very different because people in their 50s typically are married and they're pretty established in their careers. So not only that means that they have higher paychecks, but it can also mean that they have 2 incomes to work with. So money is typically not an issue, but time is, because people in their 50s are coming up on retirement and have to keep that as a consideration too. So as you can see, a same goal, same decision, buying a home, but looks very different for someone in their 20s versus someone in their 50s. Another example would be technology. Some people could care less about technology, and some people love it very much. So you may have one person buying a TV, having the same TV for the next 15 years until it dies, or you may have another person who wants to have multiple TVs in their home and upgrades those TVs as new technology becomes available. Again, same decision, buying a television, but looks very different because people are different. So what I'm trying to say here is that these secondary goals don't have a specific dollar amount that would be universal for everyone, and they don't have a specific order that would be universal to everyone. So you'll just have to deal with them as they come up in your life, and you'll have to assign an amount to it as appropriate for you and your family. But speaking of dealing with these secondary goals, basically you have two ways that you can handle them. First one being is that you can work in your secondary goals in between your main goals. And what that would look like is maybe you got done saving for an emergency fund, and then next you're going to move on to saving for a vacation, and then you're going to come back and continue saving for a retirement at that point. So you would basically zigzag and alternate as appropriate. Now this strategy works really well on larger things, so things like vacations and home down payments and possibly even car down payments. The second approach would have you work on one of each goals at the same time. So one main goal and one secondary goal concurrently. So maybe you're saving for a debt, or maybe you're repaying your debt on the main goal side. And then at the same time, maybe you're saving for a Christmas fund on the secondary goal side. So that would be an example of working on two goals at the same time. Now, ideally, I recommend you work on one of each if you can. But you can add more if you need to. So, for example, maybe you are working on establishing a 6 months emergency fund, and at the same time you're working on a Christmas fund and saving for a large purchase and saving for a vacation. So you have 4 things in this case that you're working towards. So you can do that, but please keep in mind that the more things you have in the mix, the more stressful and overwhelming they get, and the more time it takes to complete each one. So again, ideally, I recommend one of each, but if you have to have more than one, then I would recommend one main goal and then no more than 2 secondary goals at the same time. So I hope this video was helpful, and I'll see you in my next one. Again, please consider subscribing to my channel and giving this video a like. This was Alona, and I'll see you in my next video.